Welcome to the deep dive. Today, we're looking at something pretty interesting, actually. A company missed its earnings per share target. But get this, its stock price went up and its revenue actually beat the forecasts. How does that work?
Yeah, it's a bit of a head scratcher on the surface.
We're diving into Agilysys and their Q1 fiscal year 2026 report.
Right. Our goal here is to, cut through those headline numbers, figure out the real story underneath, and see what's actually making investors feel good about this company. We'll explore what it signals for Agilysys' strategy, particularly in that hospitality software market. We'll boil down the key facts for you.
And we're using the official earnings call transcript and a related press release, so we've got the core info right from the source. Okay, so let's unpack this. The paradox. Agilysys' Q1 revenue was $76.7 million. That's nicely above the $74.35 million expected. A solid beat.
Over 3% higher.
But then the earnings per share, the EPS, came in at $0.33. The forecast was $1.36, so an 8% miss there. And yet, Agilysys stock climbed 1.71% in aftermarket trading. That immediate reaction, that's pretty telling, isn't it?
It absolutely is. What's fascinating, I think, is that the market clearly decided to look past that immediate EPS number. Investing Pro gives Agilysys a good overall financial health score, especially for growth and profit metrics. And that kind of backs this up. For a software company like Agilysys, especially one that's actively shifting its strategy, investors often value that strong top-line growth and crucially predictable recurring revenue more than, say, a slight miss on quarterly earnings.
Okay.
It suggests they believe in the fundamental business model and where it's heading long-term.
So if it's not about chasing that immediate EPS number, what are investors focusing on here? It sounds like they're seeing signs of underlying strength that outweigh a temporary dip.
Exactly that. When a company's in transition, like Agilysys, moving more heavily into cloud subscriptions, you look at different indicators. Things like recurring revenue growth, how many new customers they're signing up, are they getting market share? Those are the real engines for long-term value. And sometimes, investing in those areas like building out the sales team or developing new tech might dent the EPS for a quarter or two. But investors seem okay with that trade-off here.
Right, and that leads us straight into the strategy. This explains that positive reaction. Agilysys just reported its 14th straight quarter of revenue growth, up almost 21% year over year.
14 quarters, yeah, that's consistency.
But the really big news, it seems, is the shift to subscriptions. Subscription revenue shot up over 44% year over year, and now it makes up, almost 66% of their total revenue. That's a huge chunk.
It is. And if you add in the annual maintenance contracts with the subscriptions, their total recurring revenue hit a record $48.6 million. That's up 28% from last year and represents over 63% of their total revenue now.
That feels like a really stable foundation.
Well, connecting this to the bigger picture, that strong subscription growth is exactly what investors like to see. It means a stable, predictable business. Customers are signing on, sticking around. And crucially, the company emphasized this growth is mostly from new business and add-on projects for existing customers. It's not just, converting old maintenance contracts into subscriptions. They're actually expanding.
So real growth, not just shuffling the deck.
Precisely. And they're getting these projects up and running faster, too. The annual recurring revenue, or ARR, installed was up 47% in the last 6 months compared to the 6 before that. They're not just selling, they're implementing.
And you see this reflected in customer choices too, right? The one-time product revenue, things like selling perpetual software licenses or hardware, that was the lowest it's been in about 4 years.
Yeah, that's a strong signal.
It really confirms customers are choosing the cloud subscription route. The transition seems very much driven by demand. Okay, so strong subscription model. What else is driving this? Let's talk innovation and just selling more stuff. The CEO, Ramesh Srinivasan, talked about completing foundation modernization work across their products and creating an interconnected ecosystem. That sounds like more than just selling individual software pieces.
That's exactly the point. It's about building a platform.
Yeah.
And a big part of that platform, maybe the core of it now, is AI. The CEO really highlighted how they're weaving AI across the product lines, calling it a serious competitive advantage.
Okay, like how? What are some examples?
Well, think about personalized upselling. Using AI to analyze guest data and hotel occupancy in real time to offer, say, the perfect room upgrade during check-in via their property management system. Or AI assisting concierge services, using natural language processing so interactions are smoother. Even AI setting room prices based on demand and availability to maximize revenue.
Practical applications.
Right. And it's not just customer-facing. They're using AI internally, too, to help developers write code faster, improve project implementations, make customer support more efficient, so it's really embedded.
That sounds pretty comprehensive. And is it translating into sales?
Apparently so. The CEO said Q1 sales were actually their second best quarter ever, up 24% compared to the same time last year.
Wow. Okay.
And they've beefed up the sales team, added a dedicated inside sales group. They feel they're covering the entire territory now, which suggests broader reach.
And are they landing new customers with this strategy?
Yep, 24 new customers in Q1.
Hmm.
Importantly, all subscription-based. And these new customers aren't just buying one thing. They're buying an average of 6 products each.
6 products. That shows they like the ecosystem idea.
It does. And for deals involving their main property management system, the average was even higher, up to 14 products per new customer.
14. Okay, they're really selling the whole suite then.
They are. And they're seeing success in specific areas, too, like food service management. That segment turned around nicely. International sales are strong. And they had a record Q1 in casino gaming. Signed a big deal with Boyd Gaming.
So this integrated system, the AI, how does that actually give them an edge? What's the so what for their competitive position?
Well, it raises an important point, doesn't it? It's not just about having good individual products anymore. By creating this interconnected system, they gather, as the CEO put it, enormous amounts of connected data. Yeah. And that data is what fuels the AI to deliver really differentiated value. Think smarter operations, better guest experiences. It makes it much harder for a competitor offering just point solutions to compete. Kind of raises the bar for everyone.
Makes sense. Okay, strategy sounds strong, sales are up. Let's look under the hood at the financials a bit more, the CFO's perspective. Gross profit margin was 61.7% in Q1. That's down slightly from last year's 62.8%. Why was that?
They pointed to a couple of things. Lower margins on some of that dwindling one-time revenue we talked about, and also the costs of bringing new professional services staff up to speed as they grow.
Right, investing in growth. What about operating costs?
Sales and marketing expenses jumped up 14.7% of revenue compared to 10.5% the year before. But there's a specific reason for that.
Okay.
Their big user conference, which is their single most expensive event, happened in Q1 this year. Last year might have been in a different quarter. They expect that percentage to drop back to more normal levels for the rest of the year.
Ah, timing. Got it. And adjusted EBITDA, that was $12.5 million, lower than the full year target rate you mentioned.
Yeah, it was. But again, they attributed that to those one-time Q1 costs, like the conference, and they reaffirmed they expect to hit their target of 20% of revenue for the full fiscal year.
Okay, so a bit noisy in Q1, but the full year picture looks stable. What about cash?
Good question. Cash and marketable securities ended the quarter at $55.6 million. That was down from $73 million at the end of the previous quarter. But they noted Q1 is usually their lowest point for cash because of how working capital flows, annual bonus payments, things like that.
Okay.
And a really positive point here, they paid down $12 million on their credit line just before the quarter ended, and then paid off the final $12 million in July. So as of July, they are completely debt-free.
Debt-free. That's definitely a strong signal.
Huge sign of financial health.
So putting this all together, what are they telling us about the rest of the year, the outlook?
Well, they kept their overall full-year revenue guidance the same, $308 million to $312 million.
Okay.
But here's the key indicator of confidence. They actually raised their guidance for subscription revenue growth. They initially expected 25% growth for the year. Now they're guiding for 27%.
Raising guidance on the core strategic metric. That's bullish.
Very much so. And remember that big Marriott PMS project they're working on. It's going well, but they said it's not even expected to contribute material subscription revenue in this fiscal year's guidance.
So there's potentially more upside beyond this year as that ramps up.
Exactly. It suggests a longer runway for growth.
Any word on acquisitions? Are they looking to buy growth too?
They mention M&A. They seem patient, opportunistic. Their main focus is clearly organic growth right now, leveraging the products they've built and the sales team they've expanded. But they're keeping their eyes open for deals that could add complementary products to their ecosystem or help them grab more market share. Not desperate, just strategic.
Okay, it sounds positive, but every company faces challenges. What are the potential risks here? What could trip them up?
Sure. They acknowledged a few things. The hospitality software market is competitive, so there's always a risk of saturation. Macroeconomic factors, if travel spending slows down, that could hurt. And then there's execution risk. Can they fully deliver on the promise of AI integration? Can the expanded sales team scale effectively? These are real operational challenges.
Fair points.
But, management seems pretty confident they can navigate these. The CEO, Ramesh Srinivasan, was quite direct, saying, "We don't see a risk of going below 20% for that adjusted EBITDA margin. It shows they're balancing investment and growth with maintaining profitability.
Hmm.
They're willing to, as he put it, feed the areas they need to feed for growth, but not at the expense of that baseline profitability."
Keeping an eye on the bottom line while investing.
Right. And another interesting point was their approach to customer migration. They call it customer centricity. They let customers decide when to move to the cloud. They don't force it. That might mean some revenue converts a bit slower in the short term, but it likely builds stronger long-term relationships,
Mm-hmm.
which is key in software.
That makes sense. Play the long game. So the CEO's closing remarks seemed pretty upbeat then.
Yeah, he summed it up by highlighting the overall sales and business momentum, that continuing surge in subscription software sales, and the pace of project installations. It definitely paints a picture of a company that feels it's executing well on its plan.
So to wrap it up, it feels like Agilysys is successfully navigating a major strategic shift. They're betting on innovation, especially AI, and a bigger sales force to really capture the move towards cloud in hospitality. And the market, despite that little EPS blip, seems to be buying into that long-term story of recurring revenue and ecosystem value.
Absolutely. And maybe a final thought for you to consider. Think about how Agilysys' deep focus on building that interconnected ecosystem powered by AI rather than just selling standalone products might be changing the game. How does that pressure other tech companies, maybe even in different industries, that are trying to innovate in established markets? What does it mean for their strategies going forward? Something to chew on.
That's a great point. Food for thought indeed. Thank you for joining us on this deep dive into Agilysys. We hope this gave you a clearer picture and maybe spark some new questions. We'll catch you on the next one.